Hi, Larry Gaines, Power Cycle Trading. In this video, I'm going to share with you the most forgiving trading strategy that exists. So what is it? Well, it's the out-of-the-money credit spread. So this is a strategy that is so useful and is so handy for all different types of market conditions. So the trade setup I'm going to show you right now is based on the NASDAQ 100. And let me show you the charts and the setup and then exactly the structure that I did. Now, when I set this trade up, it was back on January the 13th. And at that time, the market looked like it was starting to roll over. So you can see my cycle indicators, they were going negative, cycle 1, 2. So there was no momentum in the market. It was starting to go below the moving averages, the 50 and the 21. So I wanted to set up a trade where I could go short and take advantage of the market either drifting down or falling down hard or even going sideways. So based on that type of strategy, the one that I came up with that works best in this kind of condition is the out-of-the-money bull put, not bull put, but bear call credit spread. So let me just show you the chart. So what I like to do is when I execute the trade, I do it based on an out-of-the-money bear call credit spread, and I'll do it one standard deviation above the current price or higher. And I'll show you how this trade turned out. So this was put on January the 13th, and it started going down in my direction, looked real good, found the bottom, started pushing back up. Starting to get worried. Now it's going back right through where I sold it. So if I'd done this as just a short on selling the stock or the index or selling, calls or buying puts, I'd start losing money right then and there. And then it goes even higher. So I'd be losing a lot of money right there. But then it came back off, goes sideways. But during this whole process, there was no stress really in the trade. And the trade was an out-of-the-money bear call credit spread. So you can see when that trade was put on, the market was at about 42.52. When the trade expired, the market was actually at 42.70. And this expired worthless. And this was a trade set up for a 30% return on my capital at risk in 20 to 23 days. And let me show you the trade. So this was selling an out-of-the-money bear call credit spread. The short leg was that red dashed line there at 43.25, and then the blue dashed line is 43.30. So it's a hedged trade. You're totally capped in case it does go through your short strike. And by doing this, let me show you the credit received. So received for selling the 43.25 call, buying the 43.30, that's a bear call credit spread, received $1.15 or $115 per option contract. Now, if this expires, all it has to do is expire below 43.25 at expiration. I keep that full $115. My maximum capital at risk is the difference between the spread, 430.30 and 430.25. That's $500 minus the credit received, $115. So my capital at risk was $385. My profit was $115, so that's a 30% return on my capital at risk, and that's margin put up. So the market was here when I sold the spread up here, and closed right here above the price it was on that day, and I still made a 30% return. Hope that helps. Talk to you on the next video.